Yes, so April 2024, 2023 question number 4. So April 2023 question number 4, we were looking at additional information number 2. Additional information number 2. It was number 2. Additional information number 2. So as we wind up with that particular question, so we had already in this case come up with the right of use of the assets. I think what was actually having to remain, we were supposed to in this case come up with the amortization schedule, the amortization schedule. So in that additional information, we are being told that on 1st of October 2021, the company leased some equipment to boost production. The lease was for 5 years. The lease rental payments were 24 million payable semi-annually in arrears. The fair value of the equipment was 186 million. Depreciation is to be charged on straight line basis and allocated to cost of sales. The interest rate implicit in the lease is actually at 5% per half year. So these particular lease payments are actually in arrears. And of course, in this case, we've already been able to see when you're having to prepare the amortization schedule, if the lease payments are having to be done in arrears, so there's a way in this case we present what the amortization schedule. So as per our procedure, in this case, we said you must actually be able to determine the fair value of the lease liability, the fair value of the lease liability. Then in this case, also you must be able to determine the right of use of the asset. Then number 3, you have to determine the depreciation. You have to determine the depreciation. I think we had actually done all these 3. So what was remaining is for us in this case to determine the interest under the lease, the interest expense under the lease, the interest expense under the lease, and also in this case to determine the non-current liability obligation, and also in this case to determine the current liability obligation. So for these ones, we said for you to be able to determine them, then you have to in this case come up with an amortization schedule, which in this case now from that amortization schedule, we can be able now in this case to identify what were in this case what? The interest expenses, the non-current liability, and the current liability obligation for the financial year having to end 30th of September 2022. Remember, we said the lease is actually for 5 years, but in this case we said we'll only be able to prepare the amortization schedule for how many years? We'll only be able to prepare the amortization schedule for how many years? We'll prepare the amortization schedule for how many years? Only 2 years, because in this case, we are just interested to be able to know what in this case were the amounts in terms of the interest, what in this case were the amounts in terms of the balance carried down from the 2nd year. So we are not in this case interested with the 3rd, 4th, or 5th year, because the financial statements you're having to present, the financial statements you're having to present are in this case just what relevant, are in this case just what relevant, are in this case just relevant to the year ending 2022. So therefore, in this case, we just consider only 2 years. We just consider only 2 years. And therefore, we can be able to come up with that amortization schedule to be able to identify what was the interest under this particular lease and what was in this case what the NCL and the CL obligation. So we can be able to come up with the amortization schedule. So amortization schedule, we can come up with the amortization schedule, and therefore we'll start with the period. We'll start with the period. So like that, we can have the period. Then we say you go to the balance brought down, Then this is where the payments are having to be done in arrears. It means interest basically comes immediately. Interest comes immediately before payment. So interest, we'll have interest. Then we'll have now in this case what? The payment having to be done. Payment having to be done. Then we go now in this case to consider what was the principal amount we are having to settle. And then in this case, we'll have the balance carried down. We'll have the balance carried down. We'll have the balance carried down. So of course, in this case now our shillings are writing in thousands. And put shillings in thousands. So the interest we are told in this case is exactly 5%. Exactly in this case, 5%. So we'll do for 2 years. That means will be 4 periods, because in this case, the payments are having to be done semi-annually. So we'll have the first period, which will have 2 subcategory of periods, because they are being paid semi-annually. Then we have the second year, where we'll have 1, and of course, in this case, 2. So that's why in this case, we'll be able to present in this case our schedule. So that's how we'll be able to present our schedule. So it will have 4 periods. It will actually have in this case 4 periods, each and every year having 2 periods. So because they're having to be done in this case semi-annually. So this is the second year. So they also made the payment in this case semi-annually. They made the payment semi-annually. So as you're having to comment on this list, you've already been given the fair value. You've already been given in this case the fair value of the lease liability. So and therefore in this case here, we'll have 186,000. We'll have 186,000, which already in this case have actually been given there. Then we can be able to calculate 5% of this. So when you calculate 5% of this, what you get? So 5% of 186,000. 5% of 186,000. You need to calculate 0.05. 0.05 multiplied by 186,000. 0.05 multiplied by 186,000. You get 9,300. So 9,300. The amount that in this case we're having to be paid semi-annually, it was 24 million. So 24 million. So we'll put there to the payments that were being done, 24 million. This is just constant up to the end, 24 million like that, 24 million like that. So then of this amount they were having to settle, there was a principal amount element in this 24 million. It was of how much? You need to get the difference. So of this 24 million they're having to settle, there was a principal amount element of how much? You need to get the difference. 24 million minus 93. So you get what? 15. Is it 15? 15 or 14,700. You get 14,700. 14,700. Then you deduct 186,000 minus the principal amount they ended up having to settle. 14,700. So you get 171,300. So James, were you in the previous class? Were you in the previous class? And why are you having to float? Why are you in the previous class? Why are you having to float? Where is the problem? So you need to unmute and say what is the problem. So let me unmute you. Yes, tell us what is the problem.
I'm seeing the question is April 2023, question number 4.
Mm-hmm.
And part A is statement of profit or loss for the year ended 30th September 2022.
Mm-hmm.
Then part B is statement of financial position as at 30th September 2022. So that's why I'm floating.
So what are we looking at? Read what is written here.
April 2023, question 4.
Then this one.
Add, is it number 2?
Additional information number 2.
Okay.
Is that the way you've written that question before you started solving it?
No.
You need to write what we are writing on the board. Write 23 question number 4, additional information number 2.
Okay, I'm getting it right away now. It's now number 2.
We are only in this case concerning ourselves with what? Additional information number
2.
Number 2. So
Okay,
so in this case is what? The P&L account. So our main concern in that question I told you, that's what we've written here, additional information number 2. So don't concern yourself with what the full question is having to ask. I want you to get the concept of what? Leases. Only leases. You have understood now. So we're only focusing ourselves in this case what question number two. Question number 2. So don't actually in this case concern yourself with the final accounts. So we learn about published financial statements way later on. So I just wanted to know in this case how you can be able to utilize this concept. Maybe later on in this case, once we get to that particular topic. So it is clear to everyone. It is clear to everyone. It should actually be clear to everyone. So in this case, so we'll take this 171,300 and actually bring it here. 171,300. So you take 5% of this. What do you get? 5% of this. What do you get? You get 85,65. So you get 85,65. Then 24,000 minus this. You should be able to get the principal amount they were having to settle. This is the amount they were having to pay each and every period. Of this amount they were having to pay, there were 2 elements in it. So there was an element of interest and an element of this principal amount, because this was the initial liability. This is like the initial amount, like if it was actually in this case like borrowing, you would have borrowed this. So you pay the interest, you settle you pay this amount, the payment, the annual payment or installments, you settle the interest plus part of this amount. So we want to know part of this amount, how much inside this one they were having to settle. So you need to get, there's a figure you get here. You get 15,435. So you'll be able to get 15,435. 15,435. Then you deduct 171,300 minus this. You'll be able to know what was the principal amount having to remain at the end of the period. So carry forward to start here, the coming period. It is 155,865. So 155,865. So you take this one and actually bring it here. 155,865. So 5% of this. 5% of this. So 5% of that. 77.93. So 77.93. So 24 minus 77.93 is a figure you'll be able to get for the principal amount. So 16,207. 16,207. 16,207. Then you deduct from 155,865. You should be able to get 139 something. 139 or 138 something. 139 or 138. 139. 139. 139,658. So you get 139,658. 139,658. So you take it here, you bring it here. 139,658. You take 5% of this. And 5% of this. 69.83. You can see you're saying 69.83. 69.83. So you deduct to get the principal amount of this amount. How much were they settling? You'll get something like 17 or something. 17 or is it 18? You get 17,017. So 17,017, 17,017. So you deduct from here to know this amount they have settled, to know what is remaining regarding the principal amount. What is remaining regarding the principal amount? Be carried forward to the next period. You get 122,641. So 122,641. 122,641. So from this now, you can actually be able to identify the finance cost for this year we are having to account for. So in this case, it is actually the very first year. Exactly the very first year. Remember in this case, this list was actually for 5 years. The list commenced on 1st of October. 1st of October 2020. Is it 2020 or something? 2021. So, and of course, you're having to prepare financial statements for 31st. Is it 30th or 31st? 30th of September 2022. So this is when the list commenced. So this is when this amount was here. It started here. So it is for the next 5 years. Each and every year has 2 periods because they are making this payment semi-annually. Semi-annually means it is 6 months. Every year will have 2 periods. So this is the first period. First year has 2 periods. So this is the first semi-annual they have paid. So this one is paid probably end of June. This one probably end of December. End of June the second year. End of December the second year. So the schedule goes on like that. But our concern is actually in this case to be able to get the financials for the first year. The financials for the first year. So with this second year, we already in this case be able to identify the interest for this year. We'll be able to identify the non-current liability obligation, because you'll get it from the second year. No need of having to, in this case, prepare for the entire 5 years. It will be relevant for our question that you are called upon to finally prepare. The financials will be called upon to finally prepare. There's no essence of you having to continue. You just want for the first year. Remember, you're being told you prepare financials for this one. This is the first year. So you just get for the second year. So this is the first year. So we just go up to here. So don't tell me you haven't also been able to understand that one. There's no need for going for third year, fourth year, fifth year. So you've already been able to identify what? The non-current liability obligation. Then, of course, in this case, also you can be able to identify the current liability obligation, which in this case will likely be the two figures here. The two figures here. So if in this case now you assume now you are doing the entire question. So because you're not doing that now, assuming you are doing the entire question, in your statement of financial position, you'll have to include these two figures. Remember the question we are not looking into in its entirety. But now in this case, assuming you have prepared the entire question, this is how you could have been able to deal with what? This particular additional information. So that in this case, when you are preparing your final statement of financial position, you would have reported this one as what? As an non-current liability. The two of them, as in this case, what? Current liabilities. And of course, now in this case, what? The two figures here you would have added to be able to get in this case, what? The finance cost. It will be part of the finance cost or interest expense in the income statement. So while these two will go to the P&L account, this one will likely end up having to go to the statement of financial position plus these two. So now in this case, from this schedule, we can be able to identify our interest expense. So first of all, in this case, we can be able to identify the interest expense. So the interest expense, which will be part of the finance cost, the interest expense, which will be part of the finance cost when preparing the final financial statements. You will take the two figures here. This is for two periods. So it is for the first semi-annual, the second semi-annual. So it will likely be 9,300 plus 8565. So what do you get? 9,300 plus 8565. 9,300 plus 8565. 9,300 plus 8565. You get 17,865. So 17,865. So this will be one of the expenses in the P&L account. So remember, in our previous questions, we are getting an extract. But now, assuming now you've been given the entire financial statements, now you would include this one, like in our question here, assuming we are looking at the entire question. So you would have included this one as part of what? The finance cost or the interest expense. Then we said, in this case, for a lease where the lease payments are having to be done in arrears, if the lease payments are having to be done in arrears at the end of each and every period. So like these ones that were being paid in arrears. So to be able to identify in this case what? The non-current liability obligation. The non-current liability obligation, you take what? Although I've already been able to show you here. You take what? To identify the non-current liability obligation, what do you take from the schedule? To identify the non-current liability obligation, where the lease payments are having to be done in arrears. You take which figure? You can simply open back your book and you check. It's not a matter of having to think. Go open back your book, you'll see. Still thinking. So which figure do you take? Can even guess. You take the balance carried down from the second year. That's what in this case I want you to simply say. The more you say it, the more you remember it. You know, you people don't know how. The more you say it, the more you remember it. That's why I want you to say it. But the more you keep quiet, the more you'll forget about it. The more you continue keeping quiet, the more you forget. The more you say it, the more you remember it. You take the balance carried down from the second year. You people don't know how in this case these things end up having to stick. The more you say it, the more you remember it. The more you keep quiet, the more you forget. So in this case, to get the non-current liability obligation, where the lease payments are having to be done in arrears, you take the balance carried down from the second year, which in this case will likely be this figure. Which will likely in this case go to be this figure, 122,641. So therefore, after this, you can be able to say you pick what? 122,641. So like that. 122,641. What about in this case the current liability obligation? The current liability obligation. So you take what? The current liability obligation. The current liability obligation, you take what? You take the principal amount from the second year. So the more you say it, the more you remember it. The more you keep quiet, the more you keep on forgetting. You take the principal amount from the second year. The principal amount from the second year. And this one, you have to begin now. This one, you'll have to add the two figures. So don't pick only this one. You'll have to add the two figures. You take the two principal amount for the first semi-annual and the second semi-annual. So in this case, you likely in this case take 16,207 plus 17,017. So you'll have to take, don't pick only, you know, in this case for the non-MCL, you pick only one figure at the end of the period. But now in this case, for the principal amount, in this case for the CL obligation, you add the two. You'll take 16,207 plus 17,017. So what do you get? You get 33 something. So you take 16,207, you take the principal amount from the second year, but ideally, if the payments were done broken down during the year, if the payments were done broken down during the year, you add what? The two figures. You add the two figures. You get 33,224. 33,224. So like that. So 33,224. You'll get 33,224. So that's why in this case you identify what? The MCL obligation, and of course, in this case, what? The current liability obligation. So 33,224. 33,224. 33,224. So if in this case you are now tackling the entire question, now this would have actually been part of the figures you would have actually been able to include in your statement of financial position. This would have actually been part of the figure you would have included in your P&L account, but you're not doing the entire question, because if I do the entire question now, you'll start even floating more. So we'll tackle it later on. I just wanted you to get the concept of leases from that particular question. So now in this case, I want us to look at another area. We call it income taxes. So you can write income taxes IAS number 12. 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 So income taxes, International Accounting Standard number 12. So you write that particular title. Income taxes. Income taxes. IAS number 12. Income taxes, IAS number 12. IAS number 12. So what do you mean by in this case what? Income taxes. So these are simply taxes that will likely end up having to be paid what? To the revenue authority. So it likely comprises of two taxes. In this case, you have what you call current tax and what you call in this case what? Deferred tax. What you end up having to refer to as what? Deferred tax. So when you talk about income taxes, they are simply in this case payments that actually end up having to be paid. For example, in this case, if it is Kenya, to the revenue authority or Kenya Revenue Authority. So they likely end up having to be settled, maybe in this case, to be paid by the company. They usually comprise of two. We have what we call in this case what? Current tax, and what we refer to as what in this case? Deferred tax, what we refer to as deferred tax. So you can be able to write just that by having to write and say, so income taxes comprise of current tax and deferred tax. Income taxes comprise of current tax and deferred tax. Comprise of current tax and deferred tax. 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 So then in this case, you write and say, they will be charged. They will be charged on the profits. They will be charged on the profits realized by a company. On the profits realized by a company. On the profits realized by a company and paid to the tax authorities and paid to the tax authorities and paid to the tax authorities and paid to the tax authorities. So here you can actually be able to see that there are two terms having to arise here. What we refer to as what? Current. You can underline current tax, and what you're having to refer to as in this case what? The deferred tax. What you're having to in this case called what? Current tax, and what in this case you also refer to as what? Deferred tax. So from just the terms current, something that is now. Is basically in this case what? The tax for the current year. So exactly basically tax that is actually based on in this case what? The profits for the current year. And then in this case, it will be remitted currently. Is in this case having to be remitted what? Currently. So in this case, when you talk about deferred tax, just from the term defer, they are simply in this case tax obligations that in this case will arise in the company. But now in this case, they likely end up having to be like paid in future. Or in this case, they could be tax refunds that in this case, the company will not actually end up having to enjoy now, but now in this case, it end up having to enjoy in future. So you can have the taxes they'll end up having to settle currently in terms of income tax, but they can be those taxes that in this case, the tax authority will likely end up having to claim eventually in this case in future from the company. And then in this case, we refer to them as what? Deferred tax. So you can be able to write deferred current tax. What is actually current tax? You can be able to write current tax. You can write current tax and write this about current tax. Write this about current tax. It is the actual tax payable by a company. It is the actual tax payable by a company. It is the actual tax payable. It is the actual tax payable by a company. It is the actual tax payable by a company. It is the actual tax payable by a company. It is the actual tax payable by a company. Actual tax payable by a company based on the profits, realized in a financial year. Based on the profits realized in a financial year. So eventually, we'll be able to see. So in this case, like in this case here, this one is normally 30%. So those who have done public finance and taxation. So is that corporate tax that in this case, the taxman will actually end up having to charge on the profits of the year each and every year, which is normally in this case at 30%. So we'll end up having to refer to it as what? As the current tax. Then in this case also, we've been able to introduce another term here, what we call what? Deferred tax. So this is what you can be able to say in this case about deferred tax. To defer is basically in this case, defer simply basically means in future. So you're actually having to carry it in future. You're not having to settle it now, but now in this case, you'll be forced in this case to probably settle it in what? In future. So you can write this about the deferred tax. The deferred tax, you can write this about the deferred tax. It is tax payable in future. It is tax payable. It is tax payable. It is tax payable in future. It is tax payable in future. It is tax payable in future, not currently, like in this case, current tax. It is tax payable in future. which arises as a result of, what causes these deferred taxes to end up having to arise, which arises as a result of temporary differences, temporary differences, which arises as a result of, in this case, what we refer to as temporary differences. Sometimes we end up having to abbreviate this one and just say, in this case, what, TD, which arises as a result of temporary differences. Differences which in this case end up not having to be permanent, but then this is just in this case what, temporary. So temporary differences. So what in this case is actually temporary differences? What is actually in this case what? Temporary differences. You can underline this. Temporary differences. What in this case is temporary differences? So you can write this. Temporary differences. What are these temporary differences? Temporary differences are differences between temporary differences are differences between the carrying amount, between the carrying amount and the tax base, of an item in the financial statements, So temporary differences are differences between the carrying amount and the tax base of an item in the financial statements. So hope you've been able to write up to there. So confirm whether you've been able to write up to here. And you say yes. You say quickly in this case what? Yes. So can you see Ezra says yes, Ashley says yes. Those who are not able to see the board, probably in this case you are using your phone. You need to be able to ensure you've been able to expand your phone. Ensure that in this case you've actually been able to, if you're using your phone, you'll have a challenge to view. You need to try and actually increase. There's a way you can be able to increase your screen. You'll be able to view properly. Because if you can be able to see others are saying yes, then you know there's a problem at your end. Maybe you're using your phone. There's a way you can expand that screen of yours. There's a way you can be able to try and actually expand it. You'll be able to see. So there's something you've been able to say here, that when you talk about income taxes, these are ideally taxes that a company will likely end up having to pay to what? To the government. So they are usually paid in this case what? To the tax authorities. It comprises of two taxes. We refer to them as what? Current tax, and of course in this case what? Deferred tax. Current tax is basically the tax that the company is under obligation to pay in the current year. The company is under obligation to end up having to pay in what? In the current year. The company is under obligation to end up having to pay in the current year. I don't know whether you're able to still see the board. Confirm whether you're able to still see the board very clearly. Confirm whether you're able to still see the board very clearly. Confirm. I think it should be okay. So when you talk about in this case now the deferred taxes, you're having to say this ones now you won't actually end up having to pay them in the current year, but now they'll likely be claimed by the taxman in future. They normally arise. This is why now you need to be very keen, because now this is why you do major computations here under deferred tax. This one is very easy. So this one shouldn't actually bring any trouble. Where there'll be trouble is how to get this one, the deferred tax. So it is the tax payable in future which arises as a result of temporary. These are very important terms, temporary differences. So these temporary differences, they are simply differences that will likely end up having to arise as a result of a difference in what we call the carrying amount. Carrying amount, you underline that, and of course, in this case, what we refer to as what the tax base, what we refer to as the tax base. So what we mean by this, those who have done public finance and taxation will be able to understand me very clearly and actually very properly. That when you're having to prepare your books of accounts as an accountant, there are, for example, in this case, those expenses you end up having to consider. So there are those profits that are normally calculated by the accountant. The accountant, when he's having to prepare his books of accounts, he comes up with what? The profits. Just prepare the normal P&L. You do depreciation provision for bad debts, so like that. So in this case, you'll likely basically be coming up with the figures in the books of accounts. Those are basically the amounts having to be carried. The carrying amount is what is having to be presented in the books of accounts. For example, in this case, if it is property, plant, and equipment, as per the accountant, that is basically what is having to be carried in the books of accounts. That becomes what? The carrying amount. So the carrying amount here basically simply represents those amounts that the accountant has actually been able to present in his books of accounts. But ideally, when in this case, the government wants to end up having to tax you, they won't consider the accountant profits. They'll have to adjust these profits. Like for them, they don't consider depreciation. When the tax money is having to tax the company, you see in the P&L account, you normally do what? In the expenses, you normally put depreciation. And you say, for example, in this case, what? Less provision for bad debts. So in tax, you'll likely be told in this case, you need to add back on the profits what we call what? Disallowables. So the profits that in this case, the taxman ends up having to tax are not similar to the profits that in this case, the accountant would have actually been able to prepare, because for the accountant, he comes up with what? The carrying amounts in the books of accounts. But now for the taxman, he comes up with what we call what? The tax bases, the tax bases. Like in this case, for the taxman, in terms of loss of value of an asset, he doesn't actually call it depreciation. He calls it wear and tear. He calls it capital allowance. With these differences as to why in this case they arrive at the profits of having to be able to tax, you realize that in this case arises some differences. And therefore we end up having to call them what? Temporary differences. As a result of these temporary differences, then there are those taxes that will likely arise, which in this case, the taxman won't end up having to claim them now, but now he might end up having to claim them in future, or they'll actually be set off in future as a result of what? Changes in the temporary differences. So in short, what you're having to say, that carrying amounts, they are those amounts presented in the books of accounts as prepared by the accountant. Tax bases are those amounts that in this case, the taxman is actually able to consider when he's having to determine which kind of profits are supposed to be taxed by the taxman. So the taxman in this case, in his language of having to determine the kind of profits to be taxed, his language is different. The accountant, his language is also different. As a result of this, differences normally emerge. And of course, I've already been able to give you an example. If you are a good student of public finance and taxation, you've already done it. You'll be told that in this case, when you have the profits prepared by the accountant, to know the ones that in this case are supposed to be taxed, you have to do some kind of, in this case, what? Adjustments. For the taxman, he doesn't understand the language of depreciation. You see how in this case, you normally prepare the financials. Then you say in the expenses, less depreciation. For him, that is not his language. The loss of value of assets, to him, he calls it what? Capital allowances. Or sometimes he can be able to say what? Wear and tear. It depends on the kind of the asset. And that as a result of this, then in this case, normally arises what we call what? Temporary differences. So there are two terms here I'm having to mention. So before in this case, we delve deeper into having to know how these temporary differences, you end up having to calculate them. There are two terms I've actually been able to mention. So in this case, write accounting profits. So write accounting profits. What are accounting profits? You can be able to write accounting profits. You can be able to write accounting profits. So accounting profits. You can be able to write accounting profits. So what are accounting profits? You write this, accounting profits. They are profits determined using accounting assumptions and principles. They are profits, they are the profits determined by the accountant. They are the profits determined by the accountant. By the accountant. They are the profits determined by the accountant by relying on accounting principles. By relying on accounting principles and assumptions. By relying on accounting principles and assumptions. Then in this case, we have taxable profits. Taxable profits. Then we have in this case what? Taxable profits. You write this about taxable profits. You write this about taxable profits. Taxable profits. Profits determined using. Profits determined using. Profits determined, and we'll say determined by relying upon the requirements, by relying upon the requirements of the tax authorities, the requirements of the tax authorities, or laws, or we can be able to say statutes. So for example, in this case, now you rely upon VAT Act, maybe you rely upon, in this case, Income Tax Act. So you have to, in this case, observe. So before you tax, you have to observe what the requirements are under the laws regarding how you can be able to do what? Come up with taxable profits. But the accountant uses what? The principles and assumptions in accounting, like IFRS, IS, those ones. Then I prepare the books. But now when the taxman comes in, you tell him part of the language you're having to use, I don't understand it. I need to adjust these profits of yours, and therefore in this case arises what we call what? Taxable profits. As a result of the differences, how the taxman thinks about how much is supposed to be taxed and how much, in this case, the accountant thinks about how much is supposed to be taxed, arises in this case what we call what? Temporary differences. So we've in this case been able to predominantly mention, in this case we've actually been able to predominantly mention, in this case what? The temporary difference. So you can be able to write in this case TD, temporary difference, you write after this, and you can be able to write with a big handwriting, temporary differences, be able to write with a big handwriting, temporary differences, that's in this case what? In bracket, TD is equals to the carrying amount minus the tax base, carrying amount minus the tax base. You can be able to write with a very big handwriting that temporary differences is equals to the carrying amount minus the tax base, the carrying amount minus the tax base. There's another big handwriting. Therefore, you know how you write therefore, deferred tax. Therefore, deferred tax is equals to the tax rate multiplied by the TD, the tax rate multiplied by the TD. Therefore, deferred tax is equals to the tax rate multiplied by the TD. And of course, now TD is the temporary differences. So it means before you calculate deferred tax, you have to get the TD, whereby you compare the carrying amount, and in this case, minus what? The tax base. So of course, now in this case, you're having to still ask yourself, this term Mwalimu is having to say carrying amount, tax base, what really is it? So after being able to use your very big handwriting of writing temporary differences is equals to carrying amount minus tax base, then big handwriting, deferred tax is equals to tax rate multiplied by TD. Under this, write what is carrying amount? Write carrying amount. Carrying amount. You need to understand what is carrying amount. So write what is carrying amount. Then you write this. It is the net book value. The carrying amounts. It is the net book value, or the amounts shown in the financial statements. It is the net book value, this carrying amount. So the carrying amount is the net book value net book value, or the amounts as per the amount as per the book of accounts, the amounts as per the books of accounts, or we just be able to say financial statements. Financial statements. Then you write this tax base. You write this tax base. You write this tax base. And tax base. It is the amount attributable to tax in the future. It is the amount attributable to tax in the future. Determined by the taxman. So in this case, this tax basis basically in this case is what the taxman is having to consider. And this carrying amounts is what the accountant has actually been able to represent in the financial statement. So they appear, for example, if it's assets, you are picking the net book values. You will take, for example, the cost of the asset minus depreciation, or the amounts that have actually been presented in the financial statements. But the taxman now in this case will actually be able to, in this case, consider different figures. So therefore, we call them what? The tax basis. We call them the tax basis. You can be able, in this case, write a very small example, so that in this case, the point should start, in this case, having to sink home, because now we are going to start looking at the competition. You can write a small example. Write an example here. Write an example. Write a small example here. Write example. Write an example. Assume an equipment has the following values. 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 Cost is equals to 4,000. Cost is equals to 4,000. Then net book value. Or you can do not net book value, but you can be able to say depreciation. So we have the cost of that equipment having to be 4,000. The depreciation is actually in this case 800. Depreciation is actually in this case what? 800. Then finally, wear and tear is equals to, in this case, 600. So put here 600. Wear and tear is equals to 600. Wear and tear is equals to 600. Wear and tear is equals to 600. So determine the temporary difference. Determine the temporary differences. Determine the temporary differences. So you can say maybe required, determine the temporary differences. So of course, you've been able to say that for you, the accountant, in this case, when you want to get the net book value of this asset, you will take the cost, you minus what? The depreciation. You should be able to get the NPV. But now we've been able to say, for the taxman, he doesn't understand the language of, in this case, what? Depreciation. For him, he knows the language of what you call what? Wear and tear. Or sometimes in this case, it could be what you call what? Capital. For example, in this case, in these buildings, they'll say what? Capital allowances. So in this case, the equipment, they'll be able to say this particular equipment is having to wear and tear. So as per the relevant laws or relevant tax laws or the tax authority, in this case, what the requirements, then they'll be able to say you need to take 4,000 minus, in this case, what? 600. But for you, the accountant, you'll be able to say, to consider the loss of value of this asset, you're going, in this case, to take what? 4,000 minus what? The dip to get the NPV. Because the NPV is what you normally present in the financial statements. But the taxman, he won't actually recognize this. And that's why I'm having to say, in this case, those who have already done PFT, or those who will eventually do it, you will see the teacher having to tell you that in this case, you need to add back this one to the profits. Then we calculate wear and tear on the equipment. Then we deduct from what? From the profits. Because for him, he just understands what wear and tear. This is the requirement as per the tax laws. That's why in this case, you can be able to determine what the taxable profits. But for you, when you prepare your financials with the accountant, you lessen what? Depreciation. And then it will bring some differences. What the taxman is considering to what is supposed to be taxed will bring some differences. So they'll be talking different languages. With these different languages arises now in this case what? Temporary differences, which now in this case will cause some of the taxes not end up having to be claimed immediately, and in this case can actually end up having to bring what we call what? Deferred taxes. So in this case, in our situation here, they have called upon us to be able to calculate in this case what? Temporary differences. But of course, in this case, being able to say it is very simple. So Zipporah, you have to in this case start with the formula. You have to start with the formula. You have to in this case say TD is equals to TD. You have to say in this case TD is equals to the carrying amount. You have to start with the formula. The carrying amount minus the tax base. Minus the tax base. We've been able to say the carrying amount is what the accountants have been able to present in the books of accounts. Is what value of this asset are we having to carry it in our books of accounts? We are carrying it at the net book value. To get the net book value, you simply take what? The cost, you minus the depreciation. The cost, you minus what? The depreciation. So then in this case, for the taxman, he'll be able to say he doesn't understand this language of depreciation. He understands what? Wear and tear. That's what is required in this case in what? The tax requirements. And therefore, for him, he'll be able to say cost minus wear and tear. That will be his language, wear and tear. So therefore, in this case, it simply means for us to be able to get the temporary differences, we'll be able to say the carrying amount, you should be able to get it. We'll take 4,000 minus, in this case, depreciation, which is actually 800, like that. Then in this case, we minus the tax base, we can be able to get it, or the taxman will be able to consider. So in this case, we'll be able to take 4,000 minus 600 like that, minus 600 like that. So what do you get? When you do the mathematics there, what do you get? The mathematics there, what do you get? When you do the mathematics there, what do you get? You get negative 200. So you get negative, in this case, what? 200, negative 200. Of course, for negative in accounting, you normally put a bracket like that. You'll get negative, in this case, what? 200. You'll get negative 200, negative 200. So Ezra, you get negative 200. That is actually very correct. So when you get, in this case, the temporary differences having to be negative, then we end up having to refer to this one as what we call what? Deductible temporary differences. We end up having to refer to this one as what we call what? Deductible temporary differences. And therefore, in this case, arises a new term, which in this case might end up having to confuse you. Right and B, deductible. Number one, right, deductible. They are negative, they are deductible. Deductible temporary differences. Deductible temporary differences. What are these deductible? Because sometimes you can get a positive here. So those are, we call them taxable. But now in this case, we can be able to first of all understand when you get a negative, what does it mean? When you get a negative temporary difference, what does it mean? So deductible temporary differences. Deductible temporary differences. So you can be able to write this about deductible temporary differences. Deductible temporary differences. They arise when the tax base is more than the carrying amount. They arise when the tax base, you see in this case here, the tax base is having to come to how much? 3,400. And here, the carrying amount is having to come to what? 3,200. So when you minus 9, in this case, when you get a negative. You see the tax base, the carrying amount is having to come to 32. The tax base is having to come to 3,400. So you can be able to write in this case, they arise when the tax base, the tax base is more than, they arise when the tax base is more than the carrying amount. They arise when the tax base is more than the carrying amount. They arise when the tax base is more than the carrying amount. They arise when the tax base is more than the carrying amount. Is more than the carrying amount. Full stop. Full stop. They give rise to a deferred tax assets. They give rise to a deferred tax asset. They give rise to a deferred tax asset. They give rise to a deferred tax asset. Like that, they give rise to a deferred tax asset. So asset. So this one, don't worry about it. It will arise. I'll explain now when we do a full question. You see how in this case, how we're having to say it is an asset. They give rise to a deferred tax asset. Then in this case, you can go to write number 2, taxable temporary differences. Taxable temporary differences. You write this about taxable temporary differences. They arise when the carrying amount, now is the opposite. They arise when the carrying amount, this one, is when now you get a positive here. So when you get a negative, it is deductible. When you compute, for example, in this case, then eventually you get a positive here, positive TD, we call it taxable. It is now taxable. Taxable temporary difference. So in this case, you can be able to write and say, they arise when now the opposite has happened. They arise when the carrying amount, is more than, the tax base. They arise when the carrying amount is more than the tax base. They arise when the carrying amount is more than the tax base. They arise when the carrying amount is more than the tax base. So they give rise to, what do you think they'll give rise to? They give rise to a deferred tax. They give rise to a deferred tax. They give rise to a deferred tax what? They give rise to a deferred tax what? If these ones they are giving us an asset, these ones give us what? A deferred tax liability. They give rise to a deferred tax liability. And of course, when you do a full question, you will see. So don't start questioning yourself. You haven't understood that one. So you don't have to understand it now. When we do now a full question, you're going to understand how in this case you're having to say it is a liability, it is an asset, so like that. So they give rise in this case what? A deferred tax liability. This means in this case, if it's a positive here, you are liable. You are liable because now in this case you see, remember I told you that in this case deferred tax, you know deferred tax you take, deferred tax. If you look at the formula, deferred tax is equals to what? Deferred tax is equals to the tax rate multiplied by the temporary difference. So if you get a positive here of 400, let's assume this one is 30. So it means now in this case, the taxman will likely end up having to claim from him, if this one is 30%, will claim from him, in this case, what? Is 120 or what is it? It's 120. Okay, if it's 120, and do the math there. And do the math there. It is 120. You can see it is positive. It is positive. It's just the same case in this case, for example, if you file your returns, then you realize it is negative. You normally call it what? A tax refund. So when you file your returns, when you file your returns on iTax, then it comes as a negative. It means that in this case, you are claiming from the taxman. So it is like you are gaining. So it is a negative tax asset. You are gaining. It's an asset. Same case. So now in this case, it is a positive. It means you have to pay the taxman. So it is a positive. You see, if it is a positive, it is taxable. It's positive. It is taxable. You are paying now KRA. But now, if you, for example, the same case, if you are filing VAT, then it becomes a negative VAT. So that in this case, you are comparing the output and the input. Then it is it's like you are claiming from the tax. It is like your benefit to you like an asset. But now in this case, when it comes as a positive, things have gone marambas. You have to in this case do what? Pay the taxman in that case. So that's what you're having to say. If it's taxable, if it's positive here, you are like paying the taxman. You are paying him. So that aspect, just the same when you are filing your returns, then you realize that it has come as a negative. you are claiming from the taxman. When you realize it has come as a positive, you have to pay the taxman. So the same case, if in this case it is positive, then it means in this case it is taxable. If it's negative, then it means in this case it is what? Deductible, and therefore it brings about what? An asset to you. But now in this case, it is positive, you are paying, it brings about what? A liability to you. A liability to you. So we can now in this case look at a question. I want us to look at a question. You need to open this question. December 20, or not December, we can start with this one, April 2022, question number 5B. So April 2022, question number 5B. You need to open that question. April 2022, question number 5B. So open that question. Open that question as we take a break of 3 minutes, a break of 3 or 5 minutes. So when we come back, you should be having it. April 2022, question number 5B. So as we take a break of 5 minutes, so when we come back, you should already be having the question. So April 2022, question number 5B. Yes, so confirm whether you have the question there. Confirm whether you have the question there at hand so that we can be able to look at it. So confirm whether you have it. Confirm whether you have it. In the chat there, you can be able to confirm whether you have the question. So we said you need to print the questions and have them. You need to print the questions and have them so that when you say, go to this question, so I can see 𝐘𝐫 says yes. It is only 𝐘𝐫 who asked the question. It is only 𝐘𝐫 who asked the question. What about the rest? I can see James says yes. I can see Zipporah yes. Wambua yes. So only 4 people out of 34. Only 4 people out of 34. Yes, you need to be typing there very fast. Yes, yes. So I told you the more you respond to the chat very fast, the faster we move. So the more you keep on relaxing, then we'll move a bit slowly. So we need to be responding very fast. You've gotten the question. So we need to we go. So the question in this case is having to say that 𝐦𝐚 Limited, a public limited entity, is in the process of finalizing financial statements for the year ended 31st of October 2021. The following information has been extracted from the accounting records for the purpose of estimating the deferred tax balance. Inventory is stated in the financial statements at the lower of cost and net realizable value. The company wrote down its inventory by 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purposes until the inventory is actually sold. Trade receivables had a carrying amount of 450 million after making a general provision for doubtful debts of 30 million. The provision is not allowed when in this case you are computing taxes. Property, plant and equipment has a carrying amount of 3050 million and has a tax base of shillings 2750 million. During the year ended 31st of October 2021, property was revalued upwards by 150 million. During the year to 31st of October 2021, development expenditure amounting to 480 million was capitalized. Amortization of shillings 20 million was charged to profit or loss for the year. This development expenditure was allowed for tax purposes in full during the year. Then trade and other payables are carried at 600 million. Included in the other payables are accrued expenses of 100 million, whose related expenses are deductible for tax purposes on cash paid basis. Deferred tax liability at the start of the period, that is 1st of November, amounted to 272 million. The income tax rate is actually 30%, which is supposed to be applied. Required. Compute the relevant temporary differences. The number 2, deferred tax account as at 31st of October 2021. So the question was 9 marks. So in this case, we've already been able to say that when we talk about temporary differences, you need to write this. Temporary differences is equal to, in this case, what? The carrying amount minus the tax base, We've already been able to say that carrying amount minus the tax base. The carrying amount is what in this case is being presented in the financials. The tax base is what the taxman would have actually been able to consider when he's having to, in this case, think about coming up with the taxable profits. So therefore, in this case, you can be able to come up with that table. You will be able to write carrying amount. You write carrying amount. Then you write tax base. Then you write TD, temporary difference. So you'll basically be looking at all those items. What is the temporary difference arising for each and every item? So of course our shillings are actually in what? In millions. Our shillings are actually in millions. You need to write, we are dealing with what? Serious money. We are serious people dealing with serious money. So we are not jokers. We are dealing with millions of money. We are not jokers here. We are dealing with millions of money. So millions of money, millions of money. So the first item there is actually inventory. Exactly what inventory. So you need in this case to be very careful. Now in this case, as we go through those what statements. So you're told inventory is stated in the financial statements at the lower of costs and net realizable value. What they have actually been able to present in the financial statements, you compare two figures, the NRV and of course the cost, you take the lower. So you are told the company wrote down its inventory by 120 million to a net realizable value, in this case, what, 1130. So of course, in this case, they had the cost, but now they wrote down to an error NRV. So the NRV was the lower of the two, because now the cost would be, in this case, ideally, 1130 plus what, 120. So in this case, it means the carrying amount they have actually been able to present in the book of accounts is the lower of the two. And the lower of the two, in this case, already as per that statement, is actually 1130. 1130. Then when you continue to read the statement, what does the taxman consider? What does the taxman consider? The reduction in the value is ignored for tax purposes until the inventory is done, is sold. What they have been able to consider as 120 up to this amount, because in this case, what this is the NRV. And this is what they consider because it's the lower of the cost, and of course, now in this case, what? The NRV. So they take the NRV to be able to present it in the books of accounts. But now the taxman doesn't consider what this reduction. So it means the tax base will be how much? If you're a good student having to actually try and actually follow what you're having to say, what do you think the tax base will be? What do you think the tax base will be? Try to juggle your mind. Juggle your mind. Juggle your mind. Try to juggle your mind. It will be 1250. 1250. I can see that is from Wambua and of course Ashley. It will be 1250. That is correct. That is correct. You'll be able to, in this case, take what? 1130 plus 120. The taxman doesn't consider this reduction. We need to add it back. He doesn't consider this reduction. We need to add it back, and therefore you'll be able to get 1250. That is very brilliant. That is very brilliant. And therefore, in this case, our TD will actually, in this case, be negative 120. We'll take this minus this, negative 120, which in this case will be deductible, a deductible temporary difference. It will be a deductible temporary difference. The taxman doesn't consider this a deduction. For him, he considers the costs. And of course, that last statement is having to tell you. The reduction in the value to the NRV is ignored. This one is ignored. Remember, in this case, the accountant is comparing two figures. The cost, which in this case is actually 1250 versus the NRV, which in this case is actually what, 1130. So he takes the lower, is what he presents in what the books of account. But the taxman doesn't consider that a reduction. For him, he considers what, the entire amount. So that's what in this case I will bring about was that temporary difference. You go to the next one. It says the trade receivables had a carrying amount of 450 million. That one is very direct. The carrying amount in this case of how much? 450 million. So the trade receivables. The trade receivables had in this case what? A carrying amount of, in this case what? 450. What are they having to say about these trade receivables? The trade receivables had a carrying amount 450 million after making a general provision for doubtful debts of 30 million. So after they had actually deducted, in this case, when you are coming up with the trade receivables in the statement of financial position, you normally take in this case the trade receivables less any provision for bad debts or bad debts written off. So that in this case, you can get what can be presented here. But now, if you look at the last statement, you're having to be told this reduction in the provision, or basically the provision, is not allowed for tax purposes. Therefore, it means the tax base will be how much? Try also to juggle your mind. Juggle your mind. James, juggle your mind. Juggle your mind. which will likely in this case be what, 480. So in this case, we'll simply take in this case 450 plus that 30. We'll be able to get in this case what, 480. Then in this case, our TD is still deductible, negative 30. It is still deductible, negative 30. So then in this case, we go to the next one there. Next one there. It is saying property, plant, and equipment has a carrying amount of 3050. This one we've already also been told, PPE. The carrying amount is actually in this case what, 3050. 3050. Then you are told 3050 million, and the tax base is actually in this case 2750. So how simple was this one? You are already being given the tax base 2750. 2750. So that means in this case the TD is how much? Give me the TD. The TD is how much now? The TD is Ezra. The TD is how much? Is 300 because you minus. It is positive now, which means it is taxable. It is a taxable temporary. It's not deductible like these ones. This one is a taxable one. Is a taxable. But that statement is not actually in this case yet complete. So you are having to be told during the year ended 31st of October 2021, property was revalued upwards by 150 million. Take note of that statement. I'll be able to in this case advise you how you'll be able to deal with it once we have completed this particular table. So I'll just be able to tell you how you deal with that revaluation. So let's go to the next one. Number 4. During the year to 31st of October 2021, development expenditure amounting to 480 million was capitalized. Amortization of 20 million was charged to the profit or loss for the year. This development expenditure was allowed for tax purposes in full during the year. In full during the year. So in this case, they had a development expenditure in this case of how much? So you are told in this case, during the year 31st of October, development expenditure was in this case what, 480 million. So in this case, they incurred what we call a development expenditure. You can be able to write development expenditure. This is an expenditure they actually ended up having to incur. Maybe they were carrying out a particular development. So they were carrying out what, a particular development. And therefore, they had to include this part of development expenditure as part of that asset. So they capitalized it. So they included this development. Maybe it was clearing of site, or maybe it was just a development expenditure they actually ended up having to incur. Which in this case, we are having to be told it was in this case 480 million. So 480 million, but now it was actually amortized. Development expenditure amounting to 480 million, which was capitalized. Amortization of 20 million was charged to the profit and loss for the year. The development expenditure was allowed for tax purposes in full during the year. Was actually allowed for tax purposes in this case in what? In full during the year. So in this case, this development expenditure, as far as it was actually presented there, you should be able to take 480 million minus, in this case, what? The 20. The amortization is like loss of value. So for us to be able to now get like the net book value, because I told you carrying amount is what is supposed to be presented in the books of accounts. So this is like an intangible asset. You can't touch and be able to feel it. And then in this case, it lost value, or in this case, 20. So it means they presented in their books of accounts, the accountants, the NPV, the carrying amount, what has been presented in the books of accounts, they consider this what amortization. And therefore, in this case, it was an amount of, in this case, what, 460. 460. That is what the carrying amount they presented in what in their books of accounts. But now, these are statements that you're having to be told there that the entire of this amount was actually in this case allowed for tax purposes. It means in this case here, it was 0. It was 0. Or alternatively, sometimes they might not actually give you that statement. What you must actually be able to take note of, in this case, if you're talking about the tax base, or in this case, what? The intangible assets that in this case you cannot actually be able to touch and actually be able to fill. The tax base in this case, as per the standard, that IS number 12 is normally in this case what? 0. It is normally 0. So of course you can be able to write it as an NB. You can be able to write it as an NB. You can be able to write it as an NB. You can be able to write it as an NB. Write an NB under this table. Write an NB under this table. An NB under this table. Write an NB under this table because you've yet to complete it. Write an NB under this table. Intangible assets, intangible assets, intangible assets, intangible assets, intangible assets, intangible assets will have a tax base. Intangible assets will have a tax base of 0. Intangible assets will have a tax base of 0. Intangible assets will have a tax base of 0. Intangible assets will have a tax base of 0. Intangible assets will have a tax base of 0. Intangible assets will have a tax base of 0. Hope you've been able to write that. But of course, now in this case, in that statement, they already told you that the entire amount, this entire amount, was actually allowed by the taxman. So it means he had deducted the whole of it. He deducted the whole of it as a development expenditure. And therefore, in this case, this one ended up having to be 0. So in that case, it means our temporary differences here will actually end up having to be 460, which will be taxable temporary differences. It will be taxable temporary differences of an amount of 460. So you can write 460 like that. So then we go to the next one. We go to the next one, which in this case, ideally, it is the last one. So you are told trade and other payables are carried in the books of accounts at an amount of 600. So trade and other payables. Trade and payables. They are carried in this case at an amount of, in this case, what? 600. They are carried at an amount of, in this case, what? 600. At an amount of, in this case, what? 600. So remember, all that you've actually been able to deal with here, from here, 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 all these ones are assets. All these ones are assets. So you can realize, but now this one is a liability. You can see that. The poorer you can see that. You can see that. The poorer you can be able to see that. All we've been able to deal with here is what? Inventory, asset. Trade receivables, asset. PPE, asset. Development expenditure, asset. But in this case, this one is actually, in this case, what? A liability. So for liabilities, in this case, they'll actually end up having to be the opposite. And therefore, you will actually end up having to present them with what? A negative. You present them with a negative like that. You can present them with a negative like that. So you are told in this case what? The carrying amount. For liabilities, you present them with a negative. It is the opposite. So these ones are all positives, but in this case, this one is a liability, negative. So the carrying amount in this case is what? A negative like that. So you are told in this case, the trade and other payables are carried at an amount of, in this case, 600. Included in other payables are accrued expenses of 100 million, whose related expenses are deductible for tax purposes on cash paid basis. So the tax base now in this case will have to take 600 minus those accrued expenses, which are basically deductible for tax purposes. So it means you'll be able to have here what? 500. But now you've been able to say you put what? Negative. So you put actually in this case what? Negative. You present them with negatives like that. And then it means here we'll have in this case there for that last figure you have to be very keen. Because now in this case you might get it as wrong. For that last figure, you actually basically have something like this. So this one is negative, so it is negative 600 minus 500. So minus 500. So what do you get when you take that? So negative 600. There are two minuses because this is the minus in between here. You know, there are minuses in between here, but now there's the minus on the figure also. You take negative 600 minus 500. You get negative 100. So that is very correct. You get in this case what? Negative 100. You people are mathematicians. You people, because when you a negative and a negative gives you a positive. You remember that language? A negative and a negative gives you a positive. And in this case, there we'll be able to have this man. So you get it is correct. So it means in this case, the total temporary differences is how much? You need to add 120 plus 30 plus 300 plus 460 plus 100, negative 100. You get what? There's a figure you should be able to get down there. You get 510. You get in this case a temporary difference of, in this case, an amount of 510. So this one is what we call what? Taxable temporary, because it is positive. It is positive, it is taxable, and therefore in this case, it will give rise to what? And therefore it will give rise to what? It is a taxable temporary difference, and therefore in this case it will give rise to Zipporah. It will give rise to what? It is positive. It is a taxable temporary difference, and therefore in this case it will give rise to it will give rise to a deferred tax liability. It will give rise to a deferred tax liability. It will give rise to a deferred tax liability. Of course, in this case, now the first part wanted us just to be able to get what? Compute the relevant temporary differences. The second part wants us to come up in this case with what? The deferred tax account. The deferred tax account. The deferred tax account. But of course, now there's something I was having to say there. Now there was something I was having to say that I think you've written an NP, you've written an NP. So that NP you've written something about, in this case, what? The intangible assets. But now in this case, you can actually be able to write another NP. You can actually be able to write another NP. You can be able to write another NP. So you can be able to write another NP and say, as per note number 3, 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 deferred tax on, as per note number 3, comma, deferred tax on revaluation gains, as per note number 3, deferred tax on revaluation gains, as per note number 3. Note number 3 is that number 3 in that question. As per note number 3, deferred tax on revaluation gains, deferred tax on revaluation gains, deferred tax on revaluation gains is to be credited, is to be credited, is to be credited, is to be credited in the deferred tax account. Deferred tax on revaluation gains is to be credited in the deferred tax account. 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 Full stop. Then you write and say, if it is a revaluation loss, 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 it is to be debited in the deferred tax account. If it is a revaluation loss, it is to be debited in the deferred tax account. If it is a revaluation loss, it is to be debited in the deferred tax account. It is to be debited in the deferred tax account. It is to be debited in the deferred tax account. So if you look at, in this case, that note number 3, so you are told that during the year ended 31st of October 2021, property was revalued upwards by 150 million. So we'll be able to consider this one now, in this case, not in the deferred tax account, which you are going to prepare here. So there, in this case, we need to prepare this deferred tax what account. So you can be able to draw a deferred tax account. So deferred tax account. Can be able to draw the deferred tax account. So like that, you need to put like that. You need to be able to put like that. You need to be able to put like that. So any account normally has, in this case, what? An opening balance. So remember, in this case, you say we are serious people. We are dealing with shillings in millions. Shillings in millions, not little money, but shillings in millions. So if you look at that question very keenly. Wambua, 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 Wambua. Look at that question very keenly. Is it Wambui or Wambua? Wambui. Look at that question very, very keenly. Look at, in this case, what? Note number 6. Note number 6. You are told the deferred tax liability as at 1st of November 2020 amounted to 272 million. This is at the start of the period. So that was the balance, like in this case, done what? Brought down. In this case, what? Deferred tax. So it is a deferred tax liability. So it means, in this case, this opening balance, we are going to put it which side of this deferred tax account. Also try to juggle your mind. Try to juggle your mind. You are told that the deferred tax liability as at first, that is at the start of the period, was in this case an amount of 272 million. Also try to juggle your mind. So we're going to put on which side of this deferred tax account. I can see Perry says debit. Winnie says debit. Ezekiel says debit. Wambui says debit. Says debit. So I can see debit, debit, debit. Zipporah says debit. Zipporah says debit. So so maybe I can be able to ask. Maybe I can also now to be able to help you now juggle your mind. Remember, in this case, you've actually been told what? Deferred tax liability. You've been told the deferred tax what? Liability. What about in this case if you are told the deferred tax asset? What if you are told the deferred tax asset? Would you have debited or credited? In this case, you're told the deferred tax asset as at 1st of November was 270 billion. So you see what I'm trying to now make you see what I'm trying to drive home. So it means we'll do what? We'll do what? For the liability, we'll do what? It means for the liability, we'll do what? For the liability, we'll end up having to do what? We'll credit. Now you see the sense before. So you see the sense now. All liability accounts normally have what? A credit balance. All assets accounts normally have a debit balance. It means this particular balance here, because you're told is a deferred tax liability, it'll have a credit balance. And then in this case, the opening balance will actually be on this side. So the balance brought down now in this case is actually 270 million. It's actually 272 million, sorry. 272 million. 272 million. So 272 million. But in this case, if you are told the deferred tax assets accounts at the start of the year was actually 272 million, because it's an asset. Assets normally have a debit balance. Liabilities have in this case what? A credit balance. So you are now having to see what the sense is actually in this case credit. So you'll actually end up having to go to the credit side. So get that one there very clearly. Then we've already been able to mention that in this case, with regard to that revaluation gain, we are going in this case to do what? To credit. You see that NP, you're having to say here, you consider the revaluation gain. But now in this case, you take the tax on it, it is 30%, multiplied by in this case, what? 150. So 30% multiplied by that, what? 150. And you should be able to get an amount of, in this case, 45. 45. You should be able to get in this case an amount of, in this case, what? 45. You should be able to get in this case an amount of 45. You get 45 like that. You get 45 like that. Then we've actually been able to consider the temporary differences during the year by looking at the items in the financial statements. We've looked at the items. Remember, we opened with a deferred tax liability of 272. This is what we opened with in this account of the deferred tax liability. It was 272. Then during this financial year, remember it is 1st of November. This is 1st of November. Then during this financial year, time has gone February, March. We looked at the items, inventory, like that. Then when you come to the end of the year, we've realized we've gotten some temporary differences. And then in this case, it means with these temporary differences, we can actually be able to get what? The deferred tax. And then in this case, we need to calculate the deferred tax. So how do you calculate the deferred tax? What have we been able to say how do you get the deferred tax? During the year, how do you get the deferred tax? Deferred tax is equals to what? It is equals to what? Deferred tax is equals to? Now you can do under this table. Deferred tax is equals to what? What is the formula? So there's a formula we've already been able to say, actually. There's a formula we've already been able to say, as you're having to learn in this class. There's a formula we've already been able to say. You take what? The tax rate, you multiply by the temporary difference. You take in this case what? Tax rates multiplied by the TP. And therefore you will take what? 30%. You've been given this one. You've actually been given this one in the question. We're not having to get it from our heads. It is in the question. Note number 7. It is in the question 30% multiplied by our temporary difference, which is exactly what 510. What do you get as a deferred tax by the end of the period? What do you get as a deferred tax by the end of the period? You get 153. Very correct. 100. This is the deferred tax liability. Because we got taxable temporary differences. They were positive, they were taxable. And then in this case, it brings about what? A liability. It brings about a liability because it is positive. Were it negative, it would have actually brought an asset. But it brought in this case what? A liability. And therefore, at the end of this particular financial period, the deferred tax liability is actually 153. So if you have to place it in this account, remember, with a liability account, the opening balance is normally here. But the closing balance is normally which side? With a liability account, the opening balance is normally here. But the closing balance is normally on which side? Is normally on the debit side. So it's normally here. So that in this case, in the next year it opens, it is normally like that. That's financial accounting. That is financial accounting. So it means this one, on 1st of November, we're having to see it is here. But when we closed the previous year, it means this one was here in this account. In the previous year, it was closing here. It was closing here. Then they carried it. It was carried down here. It was brought down here. So now we've calculated for this current year. We've been comparing the items up to December. We've gotten a liability at the end of the period. At the end of the period is normally here. Then when you open the next period, they bring it down here. So the cycle goes on like that. So it means in this case, at the end of the period, our balance carried down in terms of this deferred tax liability account is actually in this case an amount of what? 153. 153. And therefore, in this case, with that, we can be able to balance our account. And the balancing figure will actually now, in this case, go to the P&L account. It will go to the P&L account, which is considered as part of what? The income tax. It will be considered as part of the income tax expense. It will be considered as part of the income tax expense. So therefore, you have to balance it. So the balancing figure you get now goes to the P&L account, the income tax expense. So what do you get here? You get here, this is what? 219. So this one is 317. I think it's 317. So 317 minus 153. What do you get here? 317 minus 153, 164. I think it is 164. It is actually 164. And therefore, it means this one will go to the P&L account as an expense or as an income. It will go to the P&L account as an expense or as an income. We are debiting it here. We are having to debit it here. So when it goes to the P&L account, we'll credit. The double entry will be able to credit. So when you credit, is it an income or an expense in the P&L account? So we'll credit, yes. Ezekiel will credit. When you credit in the P&L account, is it an income or an expense? It is an income. So it will go there as what? As an income. It will likely end up having to go there as an income. So in short, what it means, it will end up having to reduce what? The current tax. It will likely reduce the current tax. So that's why in this case we come up with what? The deferred tax account. Remember, this account can actually basically be in two versions. It can actually basically be an asset or it can be a liability. So if it happens, the opening balance is here. Let's assume in this case they told us it is a deferred tax asset. It would have opened the balance here. The closing balance for an asset would have been here. Then we carry it down to the next period here. So if it's a liability, you open here. Then you close at the end of here. You carry this amount. This is carry. You carry. The next day it will open here. Where in this case, we're told that in this case, they opened with a deferred tax asset, it would have been here. Or in this case, assuming we calculated and got a negative here, it would have brought us, in this case, what? A deferred tax asset. And then it means what would have calculated here would have actually been a negative. If it would have actually been a negative, we've said in this case, if we have temporary difference that in this case bring about what? They're actually negative, they bring about a deferred tax asset, not a liability. It means if we would have calculated and we gotten this one negative here, we would have put the balance carried down here. Because for an asset, the closing balance is normally this side. For a liability, the closing balance is normally this side at the end of the period. But now we got positive. For positive, it brings about what? A deferred tax liability at the end of the period. And therefore, in this case, it will be on the credit side. Were these temporary differences negative, they would have brought in this case what? A deferred tax asset. Hope you are getting the point. Now, in this case, you would have calculated here, we would have closed this account this side, because with an asset account, the closing balance is normally this side. And therefore would have been able to get what? The balancing figure. So you just get the balancing figure to be able to know what was the deferred tax during the period. This is now the deferred tax expense during the period, which will be part of, in this case, what? The income taxes, which is part of the income taxes. So that's why you come up in this case with what? The deferred tax account, the deferred tax account, the deferred tax account. So that's it. We can actually be able to end there. So tomorrow we'll be able to look at another version of this particular question. We'll be able to look at another version of this particular question. So you can just be able to maybe take note of it. We look at a number of versions of this particular question here. So we look at, you can just be able to have a look at it. And now we'll be able to tackle it tomorrow. So we'll close on that one. Then we can be able to now, in this case, wind up and start on topic number 2. Start on topic number 2. So there's a question on December 2012, question number 2. December 2012, question number 2. So these questions I've already been able to share them in the group. You should be able to see them. You should be able to see them. So we look at this one, which and this, it will be the one that you'll be able to close with. So now in this case, you can actually be able to start looking at other things. But for now, we can be able to end there. Unless there's a question you can ask. Unless there's a question you can ask. Any question you might be having, you can ask before we say hooray. Before we say hooray to that. Before we say hooray to that. Larry, do you have a question? Larry, do you have a question? Ezekiel, do you have a question? Ashley, do you have a question? Ashley, do you have a question? Ezra, do you have a question? Do you have a question? So, revaluation gain or loss, explain a bit. So, we've been able to say any revaluation gains on assets, revaluation gains on assets, credit in the deferred tax account. Deferred tax account. Any revaluation losses. Any revaluation losses. Any revaluation losses. Revaluation losses. Debit the deferred tax account. The deferred tax account. So don't start thinking deeply. You just know like this. So just not like this, James. If you start thinking deeply, you'll start confusing yourself. So in this case, if it happened there was any asset that in this case was actually revalued, you are told an asset was actually revalued, calculate the deferred tax on that amount, which in this case, our rate here was actually 30%. The revaluation was actually 150. We got in this case what? 45. You credit. You go and actually credit in that deferred tax account. Were you told it was a loss, you would have ended up having to debit in that deferred tax account. In that deferred tax account. In that deferred tax account. Still, alternatively, what you can be able to do, you see, if you look at that particular note, was it not number what? Or it was not number 3. If you look at that note, not number 3, if you look at that particular note, not number 3, not number 3, if you look at that particular note, not number 3, so you are told in this case, the assets, I think the property was actually in this case for a value of 3050. Then in this case, they ended up having to do what? To revalue. So they ended up having to revalue it. So you are told that so during the year, property, plant and equipment has a carrying amount of, in this case, 3050 million and a tax base of 2750. During the year ended 31st of October 2021, property was revalued upwards by an amount of, in this case, 150 million. So still you can actually be able to add, I think, 3050 plus 150. And of course, still the net effect will likely end up having to come into what? The deferred tax account. But according to IAS, in this case, according to IAS number 12, any revaluation gains on assets, credit in the deferred tax account, any revaluation losses, you debit the deferred tax account, IAS number 12. So that is just direct as the way I'm having to say to tell you like that. So if you have revaluation gains, you do like that. So you credit that deferred tax account. Revaluation losses, you debit. It is the opposite now, that other side. So hope you are together. Hope you are together there, James. Result in Megatap Toka. So the results, I think they will be out by tomorrow. The results will actually be out probably by tomorrow. So they'll actually be out by tomorrow. They'll be out by tomorrow. So otherwise, thank you so much. So have a good night. So let's catch up tomorrow. Let me release you for the next class. Let me release you for the next class. Have a good night. See you tomorrow.